Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Man, I've got a great guest today, and I'm going to dive right in because I love this subject. It is the subject of screwing over the government. Anytime that we can, I'm sorry, that's really not what the subject is today. But for me, it is. I really, it's not that I don't like paying taxes. I'm okay with it. I would be okay with it if they just didn't piss the money away. Welcome back to the show, Joe Viery. Man, it's been a little while since you've been on. Let me give you a proper introduction. Joe is the CEO, founder of U.S. Tax Advisors Group, and we have done business with you for years. I don't even know how long at this point. Has to be hundreds of clients.
Yes.
You've done tons of properties for me. No one knows what the heck we're talking about. Joe, what are we talking about, man?
Well, Ron, we're talking about going back probably 5 or 6 years for with RP and Ron, as far as doing something. You said screwing over, the government. Well, and actually, we're doing it legally, though. That's the power
doing
of
exactly what the government wants us to do, Joe. Is that accurate? Yeah,
exactly.
Okay.
Yeah. And everybody should be using this trick, or at least they should look at it. And now I'm not saying it's for everybody, but it's probably for 85 to 90% of all owners of real estate. That's how powerful it is. And I hear a lot of objections, but there's really nowadays, there's only a handful of objections that really I consider. So,
okay, well, let's start with this. What we're talking about is cost segregation, which is accelerated depreciation of assets. So, Joe, walk us through really quickly how this works. I know we've been on the show, we've talked about this before, but for the new people, what is this? How does it work? And then we'll kind of go into some deeper stuff than we did last time.
Well, as everybody knows, real estate is a unique and powerful investment opportunity. And there's multiple reasons. And I know that on other podcasts, you probably beat the drum to death. I'm not going to get into all of the advantages of real estate. Go back and watch Ron's podcast prior. But the one I'm going to talk about is the tax advantages, and just one strategy in the tax advantages that everybody should be doing. And that is accelerated depreciation. Because what happens when you own any investment is you have gross taxable income, and you pay whatever your tax rate is. So I use 40% for illustration for combined state and federal. So if you have $100,000 in taxable income and you are in a 40% combined tax rate, you have to write a check out to the government for $40,000. The way you can reduce that legally is by expenses. So any kind of expensing is powerful, but the one I refer to is depreciation, which the IRS allows as a way of allowing the owner to say that their property is deteriorating, or I use the term used up, through ownership. And anybody who owns real estate knows what I mean. I mean, if you look at the flooring, you know that you're using up your flooring every single day, meaning it's deteriorating and it will have to be replaced. So what the IRS did years ago is they came up with a straight line method, which is they just said for a residential property, divide by 27 and a half years of the building basis. So you buy a property, I'll make up the numbers, for $500,000. You allocate $100,000 to land. That means you take $500,000 minus land, because land is not a depreciable item. So we have to back it out. The remainder, the $400,000, is your building basis. So bottom line is, on that building basis, the IRS is saying you're using that basis. If it's $400,000, you're using it up over time. Residential time is 27 and a half years. For commercial, it's 39 years. And so if you divide by 27 and a half or 39 years, you can see you're just getting a little tiny expense every year, unless you accelerate your depreciation.
little more than 3.6%, which is, I mean, it's not bad. But man, when you know that you can accelerate it, it's a pittance, really.
Yep.
It's kind of funny that the government decided that 27 and a half years the life of a property, because
I've never Googled it, Ron. I hope you do one day and let me know the answer.
what the actual, listen, I was just over in Italy, and I'm pretty sure I went in some places that were before Christ.
Right.
So they were built BC. But anyway, our government says they're 27 and a half years. We'll take them up on that.
Yep.
So okay, so you can do straight line depreciation. Let's talk about what this um, accelerated depreciation is. Why we need a cost segregation study. I guess what that is. So let's go into that a little bit, Joe.
Okay, so the alternative to straight line depreciation is the IRS recognizes that there are hundreds of components of a building's construction that fall into shorter lived assets.
Yep.
And keep in mind the term is 20-year life or less is the world that we deal with in cost segregation. So what we are breaking out, what we are identifying, what we are valuing are the items in the interior of the property called personal property, which are things like flooring, window covering, cabinets, countertops, appliances. Then we have the outside of the building, and these are land improvements, and these are in 15 year. And what are we identifying? We're identifying driveways, landscaping, lighting, patios, pools, fencing. And as a good engineering company can who knows all the rules and regulations can use the IRS's determination already for all of these components. They've already gone through court, and they've already been assigned by the IRS, not Ustagi or U.S. Tax Advisors Group. And we have to identify what those items are and break them out so that now what you have is when you file your first tax return using accelerated depreciation is you're going to have the 5-year bucket, you're going to have the 15-year bucket, and then you're always still going to have the 27 and a half year because that can't be accelerated. That's the main chassis of the building, the walls, the roof, the foundation, the windows, the doors, the HVAC, that all must remain in 27 and a half years. And so sometimes I hear pushback from an accountant that says, well, why would you want to use all your depreciation up in 1 year? Well, you're not. I'm peeling off in a residential, and I'm just using this as an example, but you can use it as an example, 25%. So on that $400,000 building, as in the example I gave you, basically I'm going to give the owner of that building a $100,000, 25% of $400,000. I'm going to give them that in accelerated depreciation. So they'll be able to get a whopping like about probably because we're in the a lesser year. It's not 100% bonus anymore, but you're still going to get a big um, deduction in year one, and then you're going to get the leftover deductions, like say 20%, you're going to get over time. So bottom line is, I'm jumping ahead of the question, but bottom line is that's what we're doing. We're peeling off the items that can be immediately and over the shorter period, 1 to 5 years can be depreciated. And that's powerful because what we're dealing with, as you know, Ron, is the time value of money. You don't want to wait 27 and a half years for this expense if you can get it today.
Look, the other thing is, why would you want to give it to the government just to get it back?
Right.
Let's not give it to them and show them why we're not giving it to them and do something useful with it, right?
Yeah, and I think something useful would be buying more real estate rather than paying the government taxes.
Funny you say, like, the numbers that you're talking about here is you end up with about 20% of the purchase price, which incidentally is the down payment money. So in essence, you're getting 100% return on your money year one, plus cash flow, plus appreciation, plus someone paying off the principal of your mortgage. All of those things are happening, and you're getting your money back Year one. It's pretty crazy. Okay, so some people have probably heard of cost segregation. They've probably heard of accelerated depreciation, and they have also heard from people who don't know what they're talking about some negatives about this. Like, number one negative I almost always hear is it's absurdly expensive, and because of that, doesn't work for single family homes. And I know you've done single family homes as low as, I don't know, $50,000, $60,000, probably all the way up to, $500 million commercial properties. How can you make a cost segregation study on a single family home affordable? And I guess maybe even before that question, what is the cost segregation study that makes that breaks? We've talked about breaking this down into chunks, but let's talk about the actual study. Like, what is that study, and then how do you guys make it affordable for a single family home investor?
So what we do is engineers, and by the way, Ron, you really do need an engineering company, a construction engineering company, to put this report together. I know there's a lot out there, the clients that they are in construction. They're the ones that are doing the work, maybe, or at least are overseeing the work. They're the contractors, and they think they know how to segregate the building. Well, yeah, everybody knows you can segregate flooring out of a building. That's really easy. But nobody knows what is behind the walls, what's behind the flooring, nobody knows the secret sauce. And that's why you need an engineer, because not only do we know engineering construction, but we also know the rules and regulations for cost segregation and what's legally allowed to be taken. And that's the key, because we defend our work. So if you get called to task, or there's a question by the IRS, we will answer those questions. And that's one of the values you're paying for an engineering company that stands behind their work, like Ustagi or U.S. Tax Advisors Group. That's what you get. So bottom line is, that's what we do in the study. We break out all the components of the building that qualify for 5-year, qualify for 15-year. And then again, we're going to have that bucket. The bigger bucket is always going to stay in 27 and a half years. We give you the report, or your accountant. And then bottom line is, they apply that in the tax return of the year of your next tax filing. So if you're on extension for 23, that means that you have time, because you're going to be filing your tax return September 15th or October 15th. And your accountant would take our results and apply them to your tax return.
Right. Okay. So some of the other objections that I hear are, and they almost always come from accountants who don't work with this stuff or barely have heard of it. The first one is, the IRS doesn't like this, and you're going to get audited if you do it. So let's just talk through that really quickly.
That's really quick. Not true.
It's just like, I'll just tell everybody out there, look, if your accountant says that, you should get a new accountant, because they don't know what they're talking about. I mean, they literally don't know what they're talking about. The IRS put this in, and I'm going to go out on a limb and try to figure out why the IRS has put this in place. Okay, which leads me to my next question. They did this because it's not like you're getting away. You're not going to get around paying your taxes. At some point here, you got to pay the piper, right? So we're kind of kicking the can down the road. Now, this is the other thing I hear from the CPAs. They're like, yeah, but you're gonna have to pay anyway, so you just as well do straight line depreciation and just pay along the way. Why would you want to take this big deduction, and then if you sell the property, you can have all this recapture? And I mean, why would you want to do that? Right? Well, I think that the government does this because they're going to get paid anyway at some point, and we'll talk in just a second about how you can not do that. But that's their idea, is that in the future, taxes are probably going to go up. You're probably going to get hit with a bigger tax bill, not a lower tax bill. I think that's what they're banking on. I'm interested to hear your thoughts on that.
Well, to try and figure out the method, what's going on in the brains of Congress and the IRS is a very difficult, and I don't really want to go down that road.
It's dangerous.
Yeah, I have no idea why they do the things they do.
I just like, I'm a true crime guy. I love these true crime documentaries. And sometimes I think if some of these people who go down the rabbit hole of like interviewing all these really psychotic people, I think at some point it damages them. It has to. Like it has to do some kind of brain damage. And this is similar. So we probably shouldn't go there. If we go and try to figure out what makes delusional people pick, we may ourselves have some delusional problems. So you're right. We probably should just skip over that.
Well, like the answer to the question, why 27 and a half years?
Yeah.
I don't know why 27 and a half years.
Funny because we buy houses all the time that are from like the 1900s, the 1800s. I mean,
hey, that's a good point. That's a good point you brought up. Back then. That's a good point you brought up, though, about the Italy and the hundreds and thousands of year old structures. I use the example that I could cost seg a house that George Washington built today if the client bought it within the last 15 years, meaning the depreciation clock starts anew. We don't care how old the building is. No, we don't care. It could be 500 years old, but as long as you bought it this year, the depreciation clock starts over again. And that's powerful to know that every time you buy a property.
It is what it is. We're going to go ahead and use it. We'll use and we're talking about cost segregation today to be able to accelerate this. So what is this recapture of which these CPAs talk about? Should we be scared of it, or should we not be scared of it, Joe?
Okay, you should not be scared of it because this is a very high level concept I will share. I'm not an accountant, and I'm not a tax attorney. So bottom line is you can get this vetted out from them. But basically what my experienced cost seg accountants will do for depreciation recapture. And by the way, depreciation recapture is a tax when you sell the building only for cash. You sell the building for cash, the IRS will charge you 25% of the depreciation you've taken over the life of the property. So that's, you got to consider depreciation recapture. But guess what? Cost seg reduces depreciation recapture. And here's the concept. I'm going to use the example of a laptop. You buy a laptop 5 years ago for $2,000. What's it worth today, 5 years later?
$500.
Oh boy, you have a great way of selling used laptops because I would say it's worth it. Definitely the idea is it's worth a hell of a lot less.
Mac. I mean, Macs hold their value more.
Yeah. So
if it's Microsoft, it's probably you probably should throw it away.
Well, that's usually what they do. They sell it for parts, $50 because somebody wants the old parts. But bottom line is you get the concept. 5 years down the road, the laptop is worth very little from the $2,000 you paid for it. So the savvy accountant will make the same discussion with the IRS saying, look, we did cost seg 5 years ago and Ustagi broke out the 5 and the 15-year lives. So basically 5 years later, what's the 5-year property worth? Well, it's not worth what it was 5 years ago. It's worth some residual small value. The 15-year property, 2/3 of that property stays, but 1/3 of it you're going to deduct from your depreciation recapture because that property is used up. And it's really easy to think about it. Look at the carpet on the floor. Is the carpet going to last 5 years? And if you had a carpet in a residence for 5 years and you wanted to sell it, what could you get for that carpet? Probably nothing.
Yeah, you rip it out and throw it away.
So bottom line is all of that comes off the table when you do cost seg, because now you're able to tell the IRS, I have used up my 5-year property because it's 5 years down the road. If it's 7 years down the road, the same argument. But then you're going to take more of your 15-year property because now it's, say 7.5 years, you're going to take half of it off the table. So that's why very few accountants know this technique. I know it's proven by my accountants, the high level accountants. And so bottom line is just remember depreciation recapture is reduced by doing cost seg.
Yeah. And if you 1031 exchange into another property, all of the taxes are deferred, including that one.
Including that one. And if you pass away and it goes to your heirs, again, no depreciation recapture. So we're only talking about the circumstances where somebody would sell for cash.
Yeah. And One other item. If you're a real estate professional and you are using cost segregation, it's an important distinction. If you're a real estate professional, you can utilize cost segregation to write off against your income, your ordinary income. Now, other people can't do this, but real estate professionals can. So if you're a real estate professional, you're writing off against ordinary income, which is taxed significantly higher than what Joe just said, right? So
Right.
in the event that you do that and you have recapture, your recapture is taxed less. It's a win anyway, all the way around. It's a win, right?
There's very few objections, Ron, that really make sense. Like we're going through them, which is great. But I mean, there are some, and one of them is what you mentioned, the passive investor versus a real estate professional. If you're, I'll pick on doctors. If you're a doctor and you have a physician income, which you do, and you buy real estate as an investment, you're a passive investor because your primary income's coming from being a physician. So, however, and the reason why that's to be considered is because there are limitations to passive investors. Now, everybody's different. I don't know. I can't give you the limitation, but when people invest in single family homes, for example, because the value of the home, the building is so low, being a passive investor, it may take you a couple of years to use your bucket of depreciation. Let's say you're capped at 40,000 and I give you 120,000 in losses. Well, you're going to take 40,000, 40,000, 40,000. So most of my passive investors will still do cost segregation. It will pencil out and it will work.
Yeah, absolutely. And plus, why wouldn't you want to have the bucket anyway?
Right.
Because passive income writes off against any passive gain that you have, not
Right.
just from that particular property, from any property, from any other source that is passive. And if you
Any
have
type of passive income,
if you have a
I mean,
business,
you could be a partner in a business.
yes, if you're a business owner, there's ways to create passive income. You know, if you have a decent accountant, and again, if your accountant says that this doesn't work or any of the other things that we've been talking about, you need to go get a different one, right? They're not creative enough. They don't understand the ins and outs of how this works. And that's, listen, nothing against CPAs. The tax code is so thick, nobody can understand all of it. But if you're going to be investing in real estate, you need to have a CPA who understands real estate investing and understands the tax code surrounding real estate investing, which this is a part. So really, really important.
Good point.
Joe, so over the last couple of years, last time I think we had you on, we talked about bonus depreciation, which was one of the greatest things ever. And who knows, we may get it back, right? But in the event that you see, I have these moments, Joe, where I want to say something, and then there's this part of my brain that just goes, "You probably shouldn't say that, Ron." I just had one of those. That's what happened, everybody. If you're listening, sometimes there's this dead pause that happens. It's because I'm rethinking what I was just getting ready to say. So bonus depreciation. We still have a little bit of it. We used to have 100% bonus depreciation. So let's talk about what that was. In 2023, we had 80%. And I think in 2024, we have something, right?
60.
I don't know how much. 60. And then I think it goes away, right?
No, 60, then 40, then 20, then 0.
Oh, okay, cool. All right, so we're going to have it for a little bit. Let's talk through what bonus depreciation is, how it works, and that way everybody can understand it. Because we talked about cost segregation and accelerated depreciation. This is like accelerated depreciation on steroids. I think it was Trump that put this into effect.
Yep.
It's gonna sunset. I guess if he gets elected, it would sunset during his term. If Biden gets elected, it'll sunset during Biden's term.
Right.
How's it
So
work?
here's the deal. So what happened during the Trump Tax Act in, I think it was in 2018, is basically they wanted to give preferential benefit to real estate for whatever reason. I don't know. But bottom line is they came up with 100% bonus.
I mean,
And the way
he's a real estate developer. Let's just be honest. He's a real estate developer.
Yes. Exactly.
Thank you, Trump, who's a real estate developer. But
Yeah.
and listen, I was going to say this before. Now it's the second time, so I feel like I have to say it. All the politicians just do whatever's best for them anyway, and Trump included. All of them.
Right.
I dare you to email me, invest@rpcinvest.com, and tell me which one you know of that doesn't do this. They all self-promote.
Yes.
So let's just be honest about it. This is the Get Real podcast. The reason why real estate people got this big boost is because Trump's a real estate guy. Right?
Exactly.
So there you have it, Joe. I said it. You didn't.
Okay, good. Thank you, Ron. So bottom line is how the rule reads. It's very easy the way it's structured. It said any property bought after September 28th of 2017 could qualify for 100% for bonus. Let's just say bonus now because forget the 100%. And what happened is that they had it for 5 years and then it started phasing out. So 22 was the last year of 100% bonus. And then it's 80, 60, 40, 20, 0. Right now, they are trying to extend it, but it hasn't passed the Senate. It's passed Congress. But what it says in the rules and regulations is any life of property in the building that's 20 years or less, you can take 100. Well, in 22 or prior, you could take 100%. So remember I said 20, we're going to find 25%. Remember in that example, the $100,000, a $400,000 building, we found 25%, which is 100,000. Then if it was 100% bonus, you could take 100% of the $100,000 and take it as an immediate write-off. Without bonus, because I started in the year 2007 and we did not have bonus until 2018. So bottom line is we didn't even know anything about bonus depreciation. We did in another definition, but in terms of cost seg and accelerated depreciation, we didn't have it. And nobody did not do cost segregation because of bonus. We didn't even know what bonus was.
Oh, yeah, the first one we worked on, I didn't have bonus, and it was amazing.
And the reason why is because I just looked this up to get a better calculation, and I did a building a new instead of a bonus illustration. And what it comes out to be, it's a timing factor because when you're mixing 27 and a half years, 15 years, and 5 year into this calculation mix, you get an effect where you get a big chunk of your depreciation year one, and then you get trails for 3, 4, 5 years. So what the math is that today, even at, I calculated this on a 23 project. So they were on extension. And bottom line is we still gave the client 80% for year one. Okay, what happens to the other 20%? You're still going to get it. It's just going to take a couple years. So in the example that I ran, it's $110,000 or $100,000 in depreciation. They got $80,000 in this year, the current tax year, and the other $20,000 they got in just a little bit each year. $2,500 or maybe $5,000 the next year, and it keeps going down until you use your bucket dry. So as long as you are going to hold the property, it's all it is a timing issue. You're still going to get a huge deduction the year you do it, even with zero bonus depreciation. So that's why for me, bonus depreciation doesn't mean all that much because most of my clients are holders. We don't want a client who's a flipper to do cost seg. We'll tell them don't.
Listen, if you're going to hold your property for a year, it makes no sense to do a cost segregation study because you're going to have all the recapture after a year. I mean, unless you're going to 1031 exchange it, it literally makes no sense to do that. Right. This is all for people who are going to hold properties. By the way, we should mention, this does not work if you are a rehabber or flipper or something like that. It's not for those types of properties. It's for income producing properties, for properties that you're going to hold.
Correct.
So it is not for those. I don't want people to call their CPA and say, well, Ron said you could do this. That's not what we're talking about. We're talking about rental properties, income producing properties. So,
correct. Yep.
Important distinction. Okay, what else should people know about accelerated depreciation, about what you guys do that I haven't asked you already?
There's one other a topic that I want to address, because I was addressing kind of like who would not do cost seg, and so there's another bucket that would be, for example, if you're a passive investor and you don't need passive losses, I will tell you don't do it. Okay, most passive investors can use them, but if you can't, then you don't do it. If you don't pay income taxes, sounds silly, but we already talked about real estate being very powerful in deductions. So you may not be paying income taxes. Your property may be, cash flowing but you may not have taxable income. I get that all the time and I understand that. But here's one reason you may not want to do cost seg, and that's if you're doing a 1031 exchange. Because what happens when you do a 1031 exchange is you have the relinquished or sold property that goes into the new acquisition. And where cost seg becomes problematic is if it's an even exchange or close to even. So let's say you sell a property for 500,000 and you buy your new property for 525. The reason why it's not going to work is because the $500,000 building you sold, that must remain in straight line. I can't touch it. So that's iced out of the equation. I only have $25,000 to work with, and it's not worth it. Don't move forward. So that might be a problem. I only what we want to see is we want to see those who trade up. So you sell a property for 500,000 and you buy one for $1 million. Now it makes sense. Now I got $500,000 to work with. So if you're doing a straight or even exchange, cost seg won't work for you. And so that's one thing that people need to know. I mean, there's not very many reasons why you shouldn't do cost seg, and we've talked about them all.
Yeah, and kind of talk through some of the. And I don't know, you guys might have other questions. If you do, please reach out. I can connect you to Joe. But I mean, I can't think of very many. I mean, we hear all the questions. You and I both hear all the questions. I think we've covered most of them today. Cost segregation has altered my existence. I remember the first study I did. Back when I did that study, there was a look back. You could redo your taxes, I think 2 or 3 years back. It was the most amazing thing. I went from owing a lot of money, and I mean a lot, to not only not owing that year, but getting a refund from the previous 2 years. Because I had never cost segregated any of my properties. I had multiple apartment complexes, a bunch of single family homes. I did all of that in 1 year, and it was life altering. Been doing them ever since. Been recommending Joe and his team to our clients ever since then. And I'm not sure who referred me to you. I can't remember at this point, but somebody said you need to call Joe. And I'm glad I did. Anyway, it's been a great partnership. I'll say a partnership. Great relationship ever since.
Ron, you mentioned one thing that we do need to address, because this is really important. You mentioned it, and everybody has to grasp this, is that we can go back 15 to 20 years from when you bought the property and make the magic work. Anything too far back, the numbers just don't pencil out. But we can do a look back study, and you do not amend your return. This is all grandfathered into the IRS code. They gave a special permission to cost segregation to go back and to easily change your depreciation on the building and get the advantage of accelerated depreciation. So don't just think of current acquisitions. You can go back 15 years, give Ustagi the profile of your building, answer some questions. And what we do, Ron, is we give everybody, as you know, a no cost estimate, where we will tell you what the fee is. We will tell you what your benefit is. We will suggest, as Ron suggested, you go to your real estate accountant or your team or your advisors, and you discuss it with them. And if it's a good idea, move forward. If it's not a good idea, then we agree with your team and your accountants. Don't move forward, because you know your situation better than anyone. So keep that in mind. You can go back 15 years on look back studies.
Yeah, and point of clarification, when I said that I was going back on my taxes, there was a in the tax law that year, and it may have been for 2 years, they allowed you to go back and amend your taxes for, I think, 3 years on anything like that, which I don't think you can do right now.
No, you can still do that. I think what you're referring to is you can get a refund of your taxes going back 3 years. So you can use the losses and cost seg and go back 3 years and get a refund of the taxes. And that is huge. And it's still in play today. You can still go back 3 years and get a refund.
So if you own a bunch of properties and you've not done this, it could be like it was for me. It could be life altering. I mean, it was truly life altering. And I was just telling Joe on the way, when he first popped on, we started talking about this. I remembered that I have a house I haven't cost segregated like an idiot. So I got to get with your team after the show and make sure we do that. I got this lone little house out there that I bought on a whim, and I never did a cost segregation study on it. So I need to get that done. Well, Joe, how can people find you? I mean, it's pretty easy. You can literally Google his name. There's not many Joe Viery's out there, but I mean, you can actually find him. It's pretty simple, but easier than that, Joe. How do people get a hold of you?
Okay, I'm going to have to, because I'm such a
look. Here's the easiest way to do it. Email us, invest@rpcinvest.com. We will connect you to Joe, and I think we got some of your contact information for your team, and we'll try to drop that in the show notes as well.
I think I got it though, Ron. Another way they can do it is ustagi.com/get-started. But easier to go to Ron. He can forward you the link, or he can forward you my contact.
We'll just CC his team on an email and send it over to you. So just either way, we'll put that in the show notes though, Joe, for people so they can click on it. That might be pretty simple. You can always email us, invest@rpcinvest.com. If you have questions, if you have comments, I asked a question during the show, and if you have an answer to that question, feel free to email me, invest@rpcinvest.com. Joe, really appreciate you being on the show again, my friend.
Ron, thank you, and I appreciate you and our relationship.
Awesome. All right, everybody. Till next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.